Yeah, hello, all. Good evening. So, welcome to today's monthly expiry analysis. So, let us get started first. Starting with the most important part of the puzzle, that is the end of the day data. Going into the expiry, if you look at the position of big players, coming to FIs, were pretty much clear in that they had shorted the futures also. They had shorted calls again bearish, and then they had bought puts. So it is unidirectional bearishness from FIs. And coming to prop desk they had marginally bought some futures long, but yeah, I mean that they had gone with some futures long quantity. This is also a kind of liquidity arrangement. Anyway, let's not get into that. And for calls also they had shorted with a higher quantity, and then puts also they've gone with a higher quantity than the FI. So overall, looking at the smart money's position, you find that the combined view of FIS and prop desk, it's very clear. Both are selling calls and buying puts. This is very bearish. Now coming to the client's position, this is where the puzzle gets complete. So the clients have done the exact opposite as the smart money wanted it actually. So they bought calls which is bullish, they sold puts also which is bullish. So this is why the data perfectly matches, and the direction is set. The direction that is set is, this data clearly shows that the market has to go down for this data to get translated into the reality. It is a must that the market has to go down. I mean, how it does it go down? It depends on various things, but it has to go down is the message which the data is trying to tell. Now, either it can go up or go down, or go down and go further down is anybody's guess based on further intraday data. But the crux from this message is that the market has to at least go down. Now, I mean, the basic point behind this data is that the market cannot move against the smart money's positions. Now, looking at the opening OI, how it kept developing. So you can see that initially there was more call rating in accordance with the EOD data. I'm seeing this for Bank Nifty. So there was higher call rating, and the call rating also was higher, and you could see the um, put unwinding, some put unwinding taking place, and then the call rating which sustained. So the interesting part in this data to observe is that there was no further interest to write the calls. This is a very interesting part of the overall development throughout the day, is that there was no further interest to write calls, and you could see call unwinding as well. And this is just marginal, and you could see unwinding here itself. The point what I'm trying to tell is, if the fall has to continue, you must we must see some more call writing apart from what has already been done. So I mean, relatively this can be observed with the help of PCR also. You can see that the PCR is almost after this maybe after this time frame, the PCR almost is flat around the same levels, right? So it's not going significantly down. In fact, it's more inclined to go up and then stay flat. So what is this showing? This is showing that there's not much further call writing taking place. So if there is no further call writing, then it shows the intention that there's no further interest to take the market down. So it means that the bearishness, which was seen in the data, has already been kind of factored in by the fall which has taken place. So the smart money is no more interested to make the market fall for their bearish positions. So this is the psychology which comes out from that data. And interestingly, you could also see some put writing also taking place, and that's why the expiry understanding is the EOD data solved most of the puzzle. So the EOD, I mean, post that you could see put writing also. It's confirming that the some intention to for the market to reverse, and you could see the short covering taking place towards the end. Same was visible with Nifty as well. So when you look at Nifty's OI, broadly initially there was correlating, but here it was pretty much clear in the sense that you could see put writing as well as call unwinding taking place. So smart money started to close their positions uh, you know in the beginning itself. So and then further you could see these are just small numbers. I mean, not big writing numbers during the course of the day. Some put writing, but this put writing again gave way towards, I mean, put unwinding gave way towards further put writing, some call unwinding, and then put writing, and you could see some call unwinding taking place. So the point here is that there was no further intention to take the market down by further call writing. So that is what the data is clearly hinting at. There's no in fact, the PCR low, if you see the PCR low of this point and this, you can generally see that there's a higher low here from the PCR also. So it clearly means that there's no higher writing which is taking place. I mean, call writing. And yeah, this is with respect to the OI. And even if you look at the overall, positions also, like for example, when you take it till maybe first 11 o'clock, you could see that 18300, and I mean 250 and 200. At least 200 was always a strong support. Even 250 kind of been there, and then the initial part where there was some call rating. I mean, you can see that's a reactionary call rating because of the fall, and then price spent a lot of time there, and ultimately in the probably maybe from 11, if you see uh, 11 to some in the middle period, you could see some call rating here and there, but there's also call unwinding. So this is also giving you a clue that with call unwinding taking place, I mean, there's no genuine reason to take the market down. And further, if you keep shifting the positions, you find that there's not much intensity of call rating, and towards the latter part, you could see put rating kind of coming up again. So this was about the OI context, and interestingly, order flow gave even stronger clues. First, let us start with Bank Nifty. So when you overall see this chart, this is a repetition. I mean, this pattern, at least I've seen many times, where this standard, when you try to join, I think this trend line, works perfectly. I mean, there's a pattern which I've seen many times where uh, because the slope of this trend line is pretty small. I mean, what the psychology comes out from this trend line is that when you see the low of this, low approximately, 450 level, 43, 450, and low of this is around somewhere around 43, 400 level. So, despite spending a lot of time, price is still not able to go down. You can see lower wicks coming. Um, Basically, the price is very reluctant to travel on the downside. So that's why you get this trend line connected, and you expect a bounce from there, showing the lack of selling aggression. And now coming to order flow, so obviously, since the EOD data was bearish, we expected a down move. So the down move came in the first half itself, and the price grinded. For the in the first half itself, we almost reached that bearish conclusion from the EOD, and then it was just grinding of the, I mean, some time-based correction. This was, I think, the point where it was decided that the market was almost not going to fall, because you could see out of the 92 K or delta, the highest is concentration is here. This is clearly passive buying. So passive buying, or you can say limit buyers also, because the price is not able to sustain below it, and immediately you could see a bounce which is taking place. And again, when the price came to this level, again there was a bounce, again confirming this hypothesis that these are limit buyers. And then one more important puzzle piece to the puzzle is what happened in the from 1 o'clock to 1:30. So if you see, observe closely this order flow, you get a lot of clues about the intent of smart money, because if you see out of this 13k, you can see some big number, 22k at the lowermost point, kind of similar condition of limit buying. Price closes above it again, and then in the next candle also you could see here 20 5k worth out of this 38k. The price is again not able to sustain below this, again it goes up, and then you could see here some stacked imbalance type of situation. So these are, you can say, kind of trapped sellers also, accompanied by limit buying condition. So here, almost in three candles, you could see some confirmation that price is not able to sustain, below the POCs. So price keeps bouncing from the POCs. It's closing above the POCs. You can see some imbalance taking place also, like this imbalance. So clearly, whatever the delta you're seeing here negative, it is not so negative when you analyze it from this context, and it's confirmed the bias that almost all the bearish positions have been offloaded, and the price maybe is getting to head upwards. And you could see with the standard logic of the delta continuing to increase, the max delta also continuing to increase, and the green patch, consistent green patch. So this basically red patch doesn't mean it is red. It means there that the passive buyers, basically the limit buyers, and it's on the same zone. So that's how the I posted this in the community tab also, and the price just took off. Same was visible even in Nifty. You could see, I mean, the same trend line I've drawn here also, and yeah, I mean, basically the same point. What I'm trying to make is around the same time frame from 1 to 130, you could see that the price is not even sustaining below any of the POCs here, despite the higher numbers. Here the numbers start to increase, it becomes 43k here, and then 44k here. You see imbalances, but despite these, prices heading upwards. So this is a clear confirmation that the it is all accumulation which is taking place here to the limit buying, and this is also a zone of 18200. Keep in mind the psychological level where big players tend to accumulate 200, such round levels, and this matters a lot when we are intending to analyze such a big event, monthly expiry, the biggest event for the month. So overall, the point is that both Bank Nifty and Nifty giving a similar order flow. Order flow confluence was working in sync, and the price just took off. Nifty's short covering was even more fierce. And coming to the price, I mean, this is where the price respected certain key levels fantastically. So first, let me look at Nifty. So when you look at Nifty, the price, if you see, when we try to analyze it from any swing, let me remove this, and yeah, if you see, for example, this is a swing which is clearly visible now. So when you try to analyze this swing, you come to the point that the price, for this swing, has traveled up to 61 percent, which is a golden ratio, and it is kind of bouncing from this zone. You could see that the price, is taking support at, it's spending time around this zone, which is very bullish. When it spends time around the golden ratio. So it is first, this is, and remember, this is a 75-minute time frame. The price is not closing below the golden ratio level, and there's a second one and third one. It makes a mini hammer, and this and takes off. So generally, when it closes up here, so ideally, if you see, if it does another retest, it can go back to the swing, and if this swing is actually a lower high of this swing, so it can be expected to touch this. So this is how the price generally behaves. So anyway, this is also as a short covering to its context, so let us not get ahead of us. But the point is, even with the simple price understanding also, the levels were pretty much clear. Coming to Bank Nifty, Bank Nifty also, if you see, one thing which is very clear from this chart is that the price is range bound. When it is range bound, sustaining at the higher levels. If you have to draw this, pick the recent swing low. You can take this as a swing low, and go to the swing high, or even this. You find that the price, Bank Nifty being a bit more volatile than Nifty, it also starts to take support maybe from the 0.786, which is also a Fibonacci ratio. So overall, even if it takes from here also, it is fine, because still it doesn't break this swing. It is in the correction territory, right, for this swing. So overall, in that context, Bank Nifty from 0.786, whenever it makes this inverted hammer, it's a very strong. In my observation, making this inverted hammer is more powerful than a hammer at the bottom, and here both are being made. So it's nobody's guess from price action also that this would be a rocket. And yeah, that's what happened. And coming to the macro context, now the concern from the macros is the rising dollar. So dollar is continuously going up because of the Fed related, debt ceiling related discussions which are taking place in the US. And till the debt ceiling thing doesn't get sorted out, the dollar is continuously going up, and that is what is adding to some weakness in our in general to the global market. So dollar now, for this earlier swing, it has, if you just try to see, it broke the 38% level, so broke 58% level, consolidated a bit, and then it is now breaking the 61 level also. So now, since it is breaking the 61, we can expect that it is going towards 0.786. And yeah, at 0.786, what it does, maybe whether it gets rejected from here, and that depends maybe on, by that time, I think we would have gotten very close towards that event. By that time, probably the decision would be out as to what the a decision is all about. So overall, the dollar is still in a, we can say, for this downswing it is retracing, but the concern is when it goes above point 0.6, uh, generally what so happens that it gets back to its previous swing. That is a general observation about any instrument. If it crosses the 60%, the golden ratio, it heads back towards its previous swing, be it high or low. So yeah, that is the overall understanding of the dollar. So the world markets are a bit jittery now, because of this debt ceiling thing. But anyway, because of the expiry contest, we had the short covering taking place. Yeah, that's it. And I hope this analysis was helpful. Thank you.